You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 3/12/2021. Well, one thing I feel about in the stock market, there's not enough intellectual analysis, study of the markets and market history. Well, I came across a book recently called Unknown Market Wizards by Jack Schwager, who is the author of a dozen books, and most notably the Market Wizards books. And I saw a lot of wisdom there. Jack, I'm so thrilled you could come on the show. And if you got a question for Jack about the market, especially after you hear what he's going to say, just send us an email to kl@kerrylutz.com. Well, Jack, you almost need no introduction. I mean, you are the institutional memory of the stock market. Now, like so many people around our age and older who remember things that are really important to remember, but that the latest iteration of market speculation has forgotten. So with that out of the way, markets today, Robinhood, technology, apps, all of these things, has that fundamentally changed the market for the better or for the worse? Or is it still the same market, just with different tools?
Yeah, I think it's in many respects the same market, because the ultimate driver of the market, well, besides economics and value, but on big swings and excessive swings, both up and down, is human emotions, and that doesn't change. So we didn't have Reddit and Robinhood and all of that, years ago, but you had excesses in emotion. In recent, now you have to go back very far. I mean, you can go to the internet bubble in 2000, 1999, ending in 1998, 99, ending in around March 2000, and you had like kind of extreme prices for stocks which really were just losing money, and they may have gone from 10 to 200 and then went to zero. So that is not much different than maybe something like Gamestop, which is a stock, and I'm not a fundamental expert on valuation of stocks, but from people who do this, you're probably realistically, maybe it's worth 10, 20, $30, and you see it swinging up, periodically for a day or two up to 200 or 300 or 400 even. And that's kind of representative of excesses in the market. Human emotion has nothing to do with real value.
Yeah, I totally agree. And hey, we're old enough to remember Koss headphones. They were the first stereo headphones invented just for audiophiles, just for listening to music. And this company, I didn't even know it was still around until I saw the whole short squeeze thing take place from Reddit and Robinhood. I didn't even know that company existed anymore.
Yeah. GameStop isn't the only one, but that was the most prominent one. But there are others which have been promoted, and then you get the crowd following. The crowd acting on emotion usually doesn't end up well.
No, never. And so, but we do have this phenomena in the market of naked shorting, because how else can there be 140% of the company's shares out there being shorted? Something's going on there. I thought there was a law against that.
No, there's not. First of all, shorting is fine. I mean, there's nothing wrong with shorting. In fact, in markets, and my history goes back, mostly in futures, and there you're always long. Long and short is no different. So in futures and FX and a lot of markets, there's no really distinction. It's in stocks where it's distinction, but there's nothing wrong about shorting. In fact, in many cases, people who go short are doing a service, because there are a lot of times fraudulent companies that promote their stocks and go to ridiculous values, and then someone does a lot of analysis and say, hey, this thing's a fraud, and puts it out. Now, I would argue they're doing a good service. They're not the evil people. It's kind of gotten to this situation where people think promoting something, even if it's worthless, to make a lot of money is good. And people who say so come out, and in a case where it's appropriate. That's all I'm using this as an example, but there are only some stocks where this is appropriate. But in the cases of fraud, which is the most obvious thing where I think shorting is morally correct, we've gotten this twisted mentality about it. There's nothing wrong with shorting. You can go long, you can go short. It's a free country.
I couldn't agree with you more, but the naked shorting where Wall Street, through its machinations, doesn't bother to borrow the shares. They just forget to borrow them and they sell them. And then you've got 40% phantom shares, probably more than that with GameStop. That can't be allowed to happen, can it?
Well, even there, what happens is, people, borrow the stock and then it gets borrowed from them. So you can have these situations where you have more than 100% short. In a situation like that, the short side has risk because they are excessively exposed. There's more shares short than are around, so they're taking that risk. It's a choice of that they're making. If they're wrong, and the fact in the recent case with GameStop, the fact that the short was so large really blew up in their face. So that's a risk they take.
Yeah, I remember the good old days when I think the short interest was published once a week in the Wall Street Journal, and you could pick out those stocks that had over 10% short interest, pretty much buy them safely, knowing that there was going to be a short squeeze. But 140%, it's like guaranteed because you're really out there, you're really exposed. So as far as the individual making money in options and futures, can anybody do it, or do you require a certain mindset that very few people possess?
Okay. Basically, I think if you do enough work and if you follow and do things right, and I try to express, what those are in the various Market Wizard books, you can do okay. Most people can do okay. But to be like the people I cover in my book, for example, in this latest book on Market Wizards, one fellow, Jeffrey Newman, he started out and I get statements from people because these stories are almost unbelievable. People say, yeah, I did this. Yeah, sure. Right. Send me the statements. So, but he literally took $3,000 in, I think it was 2003 or 4. And when I interviewed him in late 2019, he had made over 50 million off of that 3,000. Wow. And I've talked to him subsequently. He's taken it over 200 million at this point. So wow. That type of performance is a rare individual. I mean, it's unrealistic for the average person to think, although you wouldn't think in the beginning he was anything but an average person. He just graduated college, never had a job, and started to trade. So there was nothing remarkable about him in that respect, but he did have this really innate skill for trading stocks through various things that he does, which I discuss in the chapter. But again, that type of performance is extraordinary. Only a rare person will achieve that. But I think there's a big difference between doing things right and just following the crowd. And if you do things right, then you can do reasonably well. And a lot of that involves proper risk management.
Right. So risk management, which is something that most of you out there don't bother with at all, right?
Yeah, sure. It's not sexy, Yeah. I mean, so to pick a stock that goes up, tenfold, well, the bragging rights, that feels really good. But making sure you don't lose your stake, well, that's, like I say, not very sexy.
Yeah. So how do you manage your risk? What do you do?
Well, there's a big difference. The key thing I think I have to point out here is you have to decide, is it an investment or is it a trade? And the answer to how you manage your risk is completely different for those two. For investing, basically, there, if you have a long-term perspective, you want your money to grow, the best thing you can do, for most people, if they don't have any particular skill in trading or you haven't done the work, getting a cheap index fund when you have the market have corrections, or particularly if you have a bear market, is ideal. That is the way, you just buy. If you get a good size reaction to market, you buy it and you buy a low cost index fund and just hold it, till you retire. That, from an investment standpoint, for most people who have no particular skill, is probably best advice. Trouble is they do it backwards. They tend to buy it when the market's making new highs. So the timing is wrong. But the idea is to just hold, you don't worry about stops and all of that. And I say an index fund because it's inherently at least diversified among stocks, although, all the stocks are correlated. Now, if you're a trader, that's very, very different. There, if you have a methodology and you say, okay, I'm going to buy stock X at $50 and I think it's going to 150, but I'm only going to risk, if it goes down to 45, I'm out. You kind of make sure that you don't lose a large chunk of your money if you're wrong on your particular pick. So for a trader, the idea is you pick your stop point where you're getting out of the stock before you put on the trade. And the important thing to understand here is you have to decide whether you're an investor or a trader before you put something on. Because if people will buy a stock and it starts going down, they'll, as a trade, and it starts going down and says, oh, well, I really believe in the stock, I'm going to hold it, it's an investment. Well, no, you have to make that decision. You have to decide, really understand what you're doing. Is it a trade or is it an investment? If you can't, just because you're losing money, say, okay, it's an investment. You can do that, but people who do that end up riding stocks or any investment all the way down.
Yeah, I gotcha. And that's where controlling your emotions becomes so important, because you don't want to get into this situation where you're rationalizing your failures and letting your failures ride, where maybe you're not going to let your successes ride like you do your failures. I've been guilty of it myself, for sure. So when we have a market like we have now, and you're kind of entering it shortly, do you stagger your entry points? So you put in X amount per month, so you're going to average up or down depending where the market's heading?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million-ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well-positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Well, for somebody young, that's fine. Because it averages, you're actually buying more when the market is down than when it's up, and as a long-term approach in a low-cost index fund, that's fine. Starting now is a bit of a disadvantage because we've got like a 12-year bull market, and I've done the research, and really, ideally you want to enter markets when the recent at least 5-year period has been poor, not good. And so now may not be the ideal time for somebody starting, but as a general principle, particularly for younger listeners out there, just investing continually over time in a low index fund, the same money averaging in is a reasonable strategy. But like I say, the main thing is to try to really put in more money when the market's doing lousy, rather than when it's doing well.
Yeah. So buy when it's going lower. And that was something I was going to ask you. So human nature, almost makes it impossible for most of you investors out there to actually buy something when it's low and when it's been hit than it does for a stock that keeps going higher and higher every day. Everyone jumps into it, and then eventually it crashes and you lose money. Why is that so difficult for people to comprehend when you've seen over time that when you buy things cheap, like Warren Buffett says, I'd like to buy $1 worth of assets for 10 cents. Why can't most people do that?
Because humans have. I did an interview in one of my market wisdom books with a fellow called Bill Eckhart, and his statement was basically human emotions are so poorly attuned to trading that people will do worse than random. He's literally saying, the old proverbial thing about the monkey throwing darts at the stock page and doing as good as the professionals. He's actually saying the monkey will do better because it is uninhibited by emotions. And that has to do, as he explains it, with the way we have evolved. We've evolved to seek comfort, whether it's shelter or food or sex or anything. We've evolved to seek comfort. And it's much more comfortable to buy a stock when everybody's enthusiastic and it's going up every day, and it's much more difficult and painful to do it when it's going down. So our innate emotions, which are evolutionary in their basis, attune us to make wrong decisions. And it takes training and understanding and methodology and commitment to risk management and discipline and all those things to change that. Yeah,
it really does. And the consensus, everybody's going along. Sometimes the consensus is right. The past few years, everyone was piling in the market. The bears were in hibernation. The bulls were really out there. And then we had the COVID and the market took a crash. But for a while, the consensus was right. The vast majority of investors was right. But that doesn't last for too long usually, does it?
Well, it can last a long time. I mean, I talked before about the internet bubble, the late 90s, like a year like 1999. Now, a great investor like Warren Buffett actually had a lousy year because the crowd was right, in those late years of the 1990s, and stocks went immensely over the stocks that didn't have value, and value stocks did poorly. But then comes the reckoning in early 2000. Now, I don't know how many of those people who rode the wave of incredibly overpriced stocks in 99 got out in time. Maybe some didn't, but probably a lot didn't. And you certainly had a lot of people who may have made fortunes in 99 and then but losing after all the smoke cleared.
Yeah, it's so fascinating, and it just happens, and it keeps happening over and over again. Though that's one of the most interesting things that I find is human nature, as reflected in the charts. It never really changes, does it?
No, that's the interesting thing. Markets change. Like from when I did my first market wishes book back in '89, we've had a tremendous amount of computerization and these firms with 100 PhDs in math working and all of that. But at the end, it's still human emotion underlying everything. And a lot of the basic principles still apply. So sure, there are strategies now that may not have existed. You may have things like we mentioned before, like Reddit or Robinhood, those type of vehicles which maybe didn't exist. But still, at the end, it's still humans making the decisions, and human emotions are something that haven't changed over over continual time. So that's why a book that a famous book called Reminiscences of a Stock Operator, written in the 1920s, about the protagonist was being Jesse Livermore, but it's about Jesse Livermore. That book still rings true even today. And I hope that my market was the original one I did 30 plus years ago still rings true today, because human emotions don't change.
Hey, and that's such a great point, because even with algorithms running most of the trades, high frequency trading, all that. Still, if you take a longer time frame, the individual actually can win at this game.
Yeah, I mean, that's all my books, all the wizard books talk about individuals who indeed have won over long periods of time. So there are, it is still possible to do. And in fact, one of the most fascinating things is the first time I ever had a trader who was a very small account in this most recent book, but it's a fellow from, of all things, he's in the Czech Republic. He just finished high school, not with good grades, went into the military, but he got interested in trading, and his job was a bellhop. And after 10 years of being a bellhop, he quit to start trading, and he's traded for 15 years with really excellent return to risk. Now, he never makes much, he never accumulates much wealth because he's living off his, he started off with 50, not even 50, 20,000, and he basically lives off his profits, but he's kind of earned a living trading, for 15 years. And here's a guy, like I say, Czech Republic, bellhop, and here he is, having succeeded in making a living off the markets.
Hey, and it can happen to you like the lottery, except I think your odds are a lot better, but you have to put in the work, you have to study, and you have to learn. And so many of you out there nowadays, Jack, just want the quick fix, the quick buck. But just like in so many things, you look at somebody and say, wow, that person was an overnight success. But then when you look closer at their career, you find out that they were a 10-year overnight success. And I think that's really what it's like for trading. But those early losses are devastating to the newbie trader. How do you get past early defeats?
Yeah, so one thing I would point out is, I've interviewed people who've made millions or hundreds of millions, been enormously successful. And in many cases, they failed, and in some cases, they failed multiple times. And it was just incredible fortitude to keep coming back and belief in themselves, and they ultimately succeeded. So the point is that even those traders who have been enormously successful in many cases had early failure. So early failure doesn't necessarily mean it's that you're doomed, it's all over. So one thing I tell people is, because it's so common for beginning traders to lose, or people in the markets to lose, is begin with a smaller stake. Don't take all your money and start trading with it. And the other piece of advice I have is, whatever your money, let's say you have $100,000 that you're going to speculate with in the market, don't risk the whole 100,000. Say to yourself, okay, if I've done, and you need to do work and preparation, you just don't start trading just on impulse, because that's not going to work. But say you've done preparation and you've got a methodology and you know how you're going to trade the markets, and you start with 100K as an example, just say, okay, I'm going to do this, but if I lose, if my account drops to 75K, I'm out. I'll close everything. I'll go back to the drawing board. I'll come back again in 6 months or whatever I feel I'm ready. And that way you don't destroy your chances for a second chance. If you kind of set the maximum you're going to lose right at the start.
Yeah. Hey, that's definitely wise. It just reminds me of that old joke. How do you make a small fortune on Wall Street, right? Start with a large one.
Yeah, that's the old joke.
Yeah, same in Vegas. Same thing. Well, so your book's available wherever fine books used to be sold? Yeah.
Well, those things called bookstores where they still exist, but really mostly it's online. I mean, any place the book is anywhere, that you would look for.
All right. Hey, I'm going to go back and look at the other books, your earlier Market Wizard books. I think there's definitely a lot to be learned here. And this is why we need people with experience, because younger people just happen to think that they often fall into the trap, that everything started the day they were born. And that's that's really kind of a jaundiced, naive look at history. You can learn a lot from history if you bother to study it. And we're appreciative to you, Jack, for your books. We will definitely talk to you again, especially if there's some market blow up or some action there to get your perspective. Anyways, go over to jackschwager.com. That's Jack, SCHWAGER.com. You'll find his books there, a lot of information, media, etc. And if you got a question for Jack, why don't you send us an email to kl@kerrylutz.com, and we'll get it to him and get you an answer. And while you're at it, sign up for our free newsletter at financialsurvivalnetwork.com. Jack, a real pleasure. Thanks so much for coming on. We'll talk to you again soon.
You're welcome, Kerry. Take care. Bye.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.